Let me start with a confession. Some of the good investment decisions I've made didn't come from research reports, conference calls, or crowded investor presentations. They came from curiosity, the discovery. Back in 2014, I came across what I'll call a company A. It wasn't in the headlines, it wasn't on anyone's top 10 ideas list. In fact, most institutional desks weren't even tracking it. And that was the opportunity. So, what is it that I look at? Step 1. Does this business matter? Before opening a spreadsheet, I ask a simple question. Does this business actually matter? Company A operated in medical devices, not the flashy kinds. No robotics, no cutting edge diagnostics. It focused on something far more understated, the consumables and everyday tools that quietly keep healthcare running. That was a classic niche. High necessity, low visibility, limited disruption risk, and more importantly, repeat usage. These weren't one-time purchases. Consumables come back. The demand is recurring. The revenues are predictable. And once a hospital is using your products, they rarely switch. That's a powerful combination. Step 2, the SKU insight. Then I looked at the product list, and honestly, it told me more than the financials. Company A had a wide and expanding stock keeping unit, which we called SKU based. In niche manufacturing, that matters more than most people realize. It tells you how deep the customer relationships are, whether the company can cross-sell, and how hard would it be for a competitor to walk in and replace them. This was not a one-product company. It was building an ecosystem. Hospitals don't want 20 vendors. They want one reliable supplier who can handle everything. Once you're in that supply chain, you become hard to replace. Step 3. Now, here's what most people underestimate risk. When a company is under research, you don't have the comfort of collective scrutiny. No analyst is checking the numbers. No institutional investor is asking hard questions. In that situation, the balance sheet becomes your first line of defense. And Company A's balance sheet was clean. Minimal leverage, no aggressive capital structure, no growth at any cost mentality, just sensible allocation of capital, controlled working capital, and expansion that was funded prudently. That is not glamorous, but in a company no one is watching, it is everything. Step 4. Financials can be dressed up, revenues can be inflated, margins can be managed, but return ratios, they are way harder to fake. Company A was delivering strong returns on capital consistently over many years, and crucially, these returns were not driven by leverage. They came from real operating efficiency. That tells you something deeper. It tells you that the business has pricing power, even if modest. It tells you management is disciplined. And when you combine sustained returns with a wide product base, it signals something I look for in every investment. Genuine institutional capability. The ability to keep performing not because of luck, but because of process. Step 5. Now here's the part which I find most interesting. What wasn't there? No analyst coverage, minimal institutional ownership, almost no market attention at all. Company A had been quietly compounding for years and almost nobody had noticed it. This is what I call a coverage gap opportunity. Markets are efficient but not equally everywhere. Where attention is low, mispricing can persist. Company A was quietly compounding but no one was watching. That is where the edge comes from. Not from being faster than everyone else, it comes from being willing to look where no one else is looking. Step 6. Management decides everything. At this point, the numbers had my attention. But the numbers get you interested. Management decides whether you stay invested. And what stood out here was the clarity of purpose. Sharp focus on the core business. No unnecessary diversification. No chasing of narratives. No new themes every quarter. Just long-term thinking and consistent execution. In every interaction disclosure, the tone was the same. Conservative, transparent, disciplined. That is rare. And in a business that no one is watching, it is invaluable. Because in companies like these, management quality is not just a factor in the thesis. It is the moat behind the moat, the investment thesis. By now, the picture was clear. Individually, none of these is extraordinary. A niche business with essential demand, a wide product portfolio and stickiness, clean balance sheet, strong potential for sustainable returns, low market attention, and high quality management. Individually, none of this is extraordinary, but together they tell a coherent story, and that is when I know I'm looking at something worth owning. Here's the biggest takeaway. Great investments are often hiding in plain sight, not because they lack quality, but because they operate in spaces that don't attract attention. And that's exactly where the opportunity lives. As portfolios grow bigger, the temptation is to gravitate towards the familiar, the liquid names, the widely covered ideas, stocks that everyone owns. But true outperformance often comes from going in one layer deeper, in industries that are boring, in businesses that are understated, in companies that are still early in the discovery phase. The question isn't whether these opportunities exist, they always have. The question is whether we are still willing to look for them.